Welcome to the U.S. Tax Forms Coach YouTube channel. My promise to you in every single video on this channel is this. By the time this lesson ends, you will know exactly what to do next. No confusion, no guessing, no wondering if you filled something out correctly. Just clear, confident, step-by-step guidance from start to finish. That is what we do here every single day. So settle in, have your documents ready, and let us walk through today's lesson together, one step at a time. We're going to completely demystify the rules for new property owners so you can confidently tackle your rental taxes. Listen, here's a really critical question for you. Are you leaving rental tax savings on the table? So many new property owners miss out on vital deductions. And honestly, it's just because they feel totally overwhelmed by complex IRS jargon and these highly specific categorization rules. You might be tracking your income and expenses in a basic spreadsheet, which is a great start, but without knowing exactly how the IRS views that data, you could inadvertently be setting yourself up for an audit. Or, maybe even worse, you're overpaying your tax bill by literally thousands of dollars.
Okay, let's dive into this. Here is our tax savings roadmap for this explainer. We're going to organize the chaos into 6 structured steps. First, choosing the right tax form. Second, reporting your rental income. Third, categorizing those rental expenses. Fourth, the absolute power of depreciation. Fifth, handling vacant and converted properties. And finally, understanding passive loss rules.
All right, starting right off with Section 1, choosing the correct tax form. Choosing the right form is absolutely your foundational step. If you start on the wrong form, the whole shebang kind of falls apart. We need to make sure you're starting off confidently. See, the IRS treats rental income differently depending on how involved you are. For standard long-term rentals, where you're basically just collecting rent and doing normal maintenance, you belong on Schedule E. This is considered passive income. The huge, massive benefit here is that Schedule E completely avoids the 15.3% self-employment tax. But wait, if you run a short-term vacation rental and you're providing substantial hotel-like services, think daily room cleaning, changing sheets, or providing meals, well, the IRS views that as an active business. That means you belong on Schedule C. And yes, you will be paying that extra 15.3% self-employment tax on your net profit.
Moving right along to Section 2, how to actually report that rental income.
Let's talk about the money coming in. Specifically, we're focusing on line 3 of your Schedule E, which is where you report your total gross rents. Now, to do this correctly, we have to talk about a tax concept called constructive receipt. Sounds formal, right? But it really just means that income must be reported in the tax year it's made available to you regardless of when it was actually earned. Let's say a tenant hands you a check for advance rent, or maybe they pay the last month's rent up front right at the lease signing. That counts as income immediately in the year you received it. You don't get to wait and report it when that final month actually rolls around.
And this brilliantly illustrates a very common trap we see all the time, receiving services instead of cash. Picture this. Your tenant is a house painter, and they say, "Hey, I'll paint your living room if you give me 2 months of free rent." Sounds like a great deal, right? Well, for taxes, you still must report the full fair market value of that rent as income on your return, then you turn around and deduct that exact same amount as a painting expense. You absolutely cannot just pretend the transaction didn't happen just because physical cash didn't change hands.
Okay, Section 3, categorizing your rental expenses. This is how we methodically lower that tax liability.
Now for the fun part, the stuff that actually lowered your tax bill. Tracking and categorizing these everyday expenses step by step is exactly how you keep more of your hard-earned money. Your Schedule E has specific lines for all of these. Did you pay for advertising to find a tenant? That's deductible. What about driving to your property? You can deduct actual auto expenses or just take the standard mileage rate, which, by the way, is a very generous 70 cents per mile for 2025. You're also going to deduct property insurance, property management fees, which usually sit around 8 to 12% of your rent, the interest portion of your mortgage payments, and any utilities you pay for the tenant. If you just keep clear records for these specific categories all year long, tax time is going to be an absolute breeze.
But here's where landlords make a massive, massive mistake. You have to understand the difference between a repair and an improvement. A repair simply maintains the property in its current condition. Think fixing a leaky pipe or patching a hole in the drywall. That is fully deductible right away in the current year. An improvement, on the other hand, adds real value or extends the life of the property. So if you put a brand new $25,000 roof on the building, you can't just deduct that all at once. You have to capitalize it and depreciate it slowly over several years. Listen, misclassifying a huge improvement as a simple repair is pretty much a guaranteed way to trigger an IRS audit.
Which leads us perfectly into Section 4,
the power of depreciation.
Depreciation is without a doubt the most powerful, yet probably the most misunderstood tax-saving mechanism you have as a real estate investor. Whatever you do, do not skip claiming your depreciation. I see owners skip this because, frankly, the math feels a little confusing, or they don't want to deal with the paperwork when they eventually sell the place. But here is the harsh reality. The IRS assumes you claimed depreciation anyway, so when you eventually sell that property, they are going to tax you on the depreciation you should have taken. By skipping it, you are literally costing yourself current tax savings today while still getting hit with the penalty later. There's no way around it. Always, always take the deduction.
So the crucial point is understanding what you can actually depreciate. You can depreciate the building structure itself, and you can depreciate improvements, but land never depreciates. Ever. When you buy a property, you have to allocate your total purchase price between the land and the building. The easiest, most bulletproof way to do this is by pulling up your county property tax assessment. Find the ratio of the building value to the land value and just apply that percentage to your purchase price. That completely isolates your depreciable building value. Simple as that.
Next up, Section 5. Let's tackle some specific scenarios with vacant and converted properties.
So, what happens when things aren't just a standard 12-month lease? Let's talk about some special situations. First, there's a really cool loophole called the 14-day rule, often known as the Augusta rule. If you rent out your personal home for fewer than 15 days in a single year, that income is 100% tax-free. You literally don't even report it. However, if you're taking your personal home and formally converting it into a full-time rental property, you've got to watch your numbers closely. Your basis for depreciation isn't just what you paid for it years ago. It becomes the lesser of its adjusted basis or its fair market value right at the time you make the conversion.
And what if your rental is just sitting empty between tenants for a couple of months? Don't panic. As long as you are actively holding the property out for rent, meaning you have it listed, it's advertised, it's ready to go, you can confidently continue to claim all your deductions, maintenance, utilities, management fees, and yes, even depreciation. You can absolutely deduct these ordinary expenses even during the months where you aren't collecting a single dime of rent.
Finally, we arrive at Section 6, Understanding Passive Loss Rules, and dealing with Form 8582.
Okay, so what actually happens when your rental operations generate a loss on paper? Because with depreciation, that happens a lot. By default, the IRS automatically classifies all rental real estate activities as passive activities. Why? Well, these rules basically exist to stop really high-income earners from just buying up real estate solely to use the paper losses to offset their ordinary W-2 wages without actually taking on any genuine economic risk. Because it's classified as passive, if your rental loses money, that loss generally can only be used to offset other passive income. You can't just apply it against your day job salary, unless, of course, you meet some very specific exceptions.
Now, what's really interesting about this slide is this incredibly helpful exception. If you actively participate in your rental, and honestly that just means you make basic management decisions like approving a new tenant or authorizing a repair, and your modified adjusted gross income is under $100,000, the IRS throws you a bone. They give you a special allowance. You can deduct up to $25,000 in rental losses directly against your ordinary non-passive income. For everyday mom-and-pop landlords, this is a massive, massive benefit. But hey, what if you make way over that income limit, or you have massive real estate losses? That is where achieving real estate professional status, or REPS, comes into play. But it's not easy. To qualify, you have to pass a really strict two-part test every single year. First, more than 50% of your total personal working services have to be in real property trades. Second, you must perform over 750 hours of actual work in those real property trades during the year. If you can meet this incredibly high bar, it's a game changer. It unlocks unlimited rental loss deductions and completely bypasses those pesky passive loss limitations. But fair warning, the IRS aggressively audits this status. So if you claim it, your daily time logs literally have to be impeccable. And that brings us to our final and maybe most important thought for this explainer. I want you to ask yourself, is your record-keeping system actually robust enough to defend your rental deductions against an audit? Clear, contemporaneous records, meaning you track things as they happen, are the absolute ultimate key to confident tax reporting. But what happens years down the line when you finally decide to sell the property? Are you prepared for the massive tax implications of depreciation recapture, or is it going to catch you by surprise and wipe out your profits completely? Well, that is a complex puzzle we are going to solve in another explainer. Until then, review your documentation today, organize those files, and ensure you are keeping every single dollar you legally deserve.